In the property investment industry, there's countless stories of the one that got away. And it's always the same reason. To pay the deposit, they needed the settlement from another property to come through, and they waited. Realty Assist Australia knows that when you find the one, waiting isn't an option. That's why they have a same-day settlement fund advance service. There's no credit check, no application fees, just a single one-off fee to advance your equity. Visit realtyassist.com.au/settlements now.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Good day, how you going? It's Phil Tarrant here. I'm host of the Smart Property Investment Show. I've been in this seat now for probably nearing 4, if not 5 years. I really should go back and have a look at how many of these podcasts we've actually recorded. There's a lot of them, and I think we've covered nearly every topic we possibly can on property investment. But just when you think you've done it all, there's always something popping up. And that's one of the beautiful things about property. It's very much orientated to the fundamentals, and the fundamentals largely don't change over time, but the conditions in which you're investing does change. And that is what the best property investors do. They set a strategy, they keep close to it and connected to it, they drive forward with it in line with and in lockstep with those changes to the situation around them. And we all know right now, Australia has largely gone back into lockdown. We're recording this on Tuesday morning, and the numbers are just out in New South Wales, not very good. We're seeing in Brizzy, numbers are spiking, and Melbourne is navigating it largely well. We're represented this week on this podcast by some good East Coast representation. We'll go into that. But the COVID lockdown, until the nation is vaccinated, we're not going to have too much clarity on how these things will pan out. Expect border closures to continue until that point in time. We're all listening to the narrative coming out of the federal government, but also the state governments about the need to go and get vaccinated. So if you haven't yet done that, do your bit for Australia, get a jab in the arm. But I'm not going to get into vaccine politics at the moment. We're here to talk about property on this property investment show. I hope you're still at it, irrespective of COVID-19. There's a lot of challenges for Australian workers, some of them more disruptive than others. That's one of the ironies of COVID-19. Some businesses excel in this environment. If anything, it's accelerated the adaptation of digital technology. So that's good for Australia. However, there's a number of different industry sectors who are getting hit right now. I think about construction, particularly in New South Wales, and some changes to how they can go about doing their work. Retail, obviously, hospitality, all impacted, and aviation as well. So this is the environment. This is what's changing, but you can continue to invest in this market. We're going to get into it today, investing effectively through COVID-19, in particular, why capital cities are important investments. So don't get swept up in all the narrative around you need to start thinking about regional and rural locations, because that's where Australia is going to be working from, considering the shift to digital. The capital cities are still the bedrock to investing successfully in Australia. Joining me in the studio, Cam McClellan, CEO, and Matthew Lewison, Director, OpenCorp. Gents, East Coast represented. Here we are.
Here we are, Phil. Back again. Good to see you, mate. I think I'm probably out of the three of us the only one not in lockdown down in Victoria, so we're stretching our legs down here, mate. But it hasn't stopped property prices elsewhere, that's for sure.
Oh, God, we'll get into that, particularly in the capital city markets. And for you, Matt, up in Brizzy, you thought that you guys were the darling of Australia. No COVID up there, but you guys have copped it with a recent outbreak, so I hope you can get on top of that. But the big news coming out of Brisbane, the Olympics, your premier went over to Tokyo and isolated for a little while, went to a couple of different functions, got told to go to the opening ceremony, held up a sign that said Brisbane, that you get in the Olympics in a few years' time, flew back and went to a fancy hotel suite somewhere at the Sofitel, I think it was, in Brizzy, copped some flack around it, but you get in the Olympics. What does it mean for property markets, mate?
It's interesting, isn't it? I think every time there's a big event, everybody gets excited and the conversation goes straight to property markets. I think, first of all, just the Olympics in itself is an amazing event. I'm super excited. I know it's 11 years away, but I've never been to Olympics. I can't wait to hopefully get a ticket to a good event and go and watch that. But I think there's a couple of things that do come out of it, isn't there? So I don't know if you guys are across, but they've changed the selection criteria for cities, which is why Brisbane was pretty much top of the table with clear space to the next city. So what they want now when they're looking for Olympic cities is infrastructure and spending programs that actually have a long-term benefit for the city. Obviously, we've seen in the past cities have gone for gold with their expenditure, and then 3 years after the Olympics, you've got these ghost stadiums and ghost towns where there's cobwebs everywhere and they're not being used. So Brisbane's plan was obviously to improve infrastructure that we already have. They're already spending a heap on infrastructure for train and rail and bus networks to make sure that the public transport system was great. So now it's going to kind of step up another level, introduce some new, obviously, games villages and some new stadiums that weren't otherwise proposed, but will be used in the long term. So if you think about it that way, it's going to be an amazing jobs boom in Brisbane for the next 11 years as all of these infrastructure projects are delivered. Then if you think about, I guess, the other spin-off from this is, I guess, global awareness of a city. Now, Brisbane has always been let's call it the poor younger sister or brother to Sydney and Melbourne. A lot of tourists go to Sydney and to Melbourne as well. Some will go through, obviously, the Great Barrier Reef, and some might visit the Gold Coast, although obviously there's a lot more Australians that do visit the Gold Coast. But it's really going to put Brisbane on the map. And we've got a great new casino that's under construction right now as well. That's going to be a 6-star resort. So you kind of think about all the people who are going to come through, all the TV awareness. So it's going to really start to bring in a lot more tourism spend for the Queensland economy in the future post-Olympics. So I guess those two things combined, one's going to really drive jobs pre-Olympics and one's going to drive it after Olympics, and obviously has long-term benefits, as I think Sydney saw as well after their Olympics. So yeah, I think it's pretty exciting. If we know that there's going to be jobs, that tends to mean there's going to be more people. And when there's more people, there's more houses and there's upwards pressure on property prices as well and rents. So yeah, I think from an investment perspective, it kind of ticks a lot of boxes there.
Yeah, look, good summary, and I concur with a lot of that. You know, I'm a sort of advocate of some of and you guys would be across demographer Bernard Salton. He talks about the Dubai effect, and the Dubai effect being, you know, in a disrupted part of the world like the Middle East where there's heaps of money washing around, whether it's Saudi Arabia or Jordan or Lebanon, most of the rich people park their money in Dubai because it's safe. And he uses the same concept for Asia, where Asian wealth, they like to park their money in Australia. So Sydney and Melbourne, yes, they've always been great locations for that. But I think this will be a real driver for Brizzy. It's you don't have a lot of sporting. You guys are playing off dusty fields and stuff up there, and not like down in the G or some of the facilities we have here. But I think it's really good for Brisbane. It's going to be long-term investment, which will see it propel both in growth. It's where most of our interstate migration takes place. And I can see a lot more people wanting to move into Brizzy. So big tick. I've got a lot of property up there as well. So obviously I'm going to talk it up. Cam, you got property up in Brizzy?
Yeah, I'm actually probably at the moment, I've got a heavier weighting of my property portfolio in Brizzy than I do the other capital cities or anywhere else. So I'm excited about what Brizzy's got in store for it, not only with where it's at before the Olympics were announced. Brizzy was cranking, and I think last July house prices rose 2.2% off the recent CoreLogic data. But one point that Matt made, which I think people need to understand, if you think of the three things that drive property prices: supply, demand, affordability. Affordability, when those jobs start, they're not going to start in 11 years. They're going to start now. So they need to start that work now. And the type of people that are doing the work to get the infrastructure and build everything that's required for the Olympics, the wages are going to increase because there's scarcity of trades and there's going to be a lot of demand on trades through Brisbane. But that money goes to real people, and those people spend the money back into the city, which drives that affordability throughout the economy. And that then will lift the property prices. So I think there's some pretty exciting times ready for Brizzy, and it won't take till the Olympics for that to kick into gear. So I'm excited, and I'm glad I've got property in Brizzy, that's for sure, mate.
Yeah, and you reckon you're going to see a lot more people moving up there? Because if I think back to all the work that took place when the Commonwealth Games were in Queensland, it was pretty hard to get a tradesperson back then. So they're all sort of living off the fat of big government infrastructure spending.
Yeah, we were lucky. We had some pretty good relationships with some pretty mid-tier builders through when the Com Games were getting constructed. But even we felt that drag on trades through Brisbane. It was really tough to get trades. Wages went up and just delays kicked in. So there is going to be definitely an impact to the trades through Brizzy as this goes forward on the general housing market, which will slow down supply coming to the market and put additional pressure on pricing.
Yeah, so this particular chat, gents, I want to focus on the capital cities, and I think we've given Brizzy a good crack. I've been waiting, like most property investors, for Brizzy to fire, and it's been one of those things. Sometimes it feels a bit like waiting for Godot, but it is now taking place. We've been in that market for 7 or 8 years, and there's been a lot of activity up there by buyers advocates and property strategists who are looking at that market. So is it now really all these things aligning for Brisbane. It's Brisbane's time to shine. What sort of growth do you think we're going to be getting in Brizzy, Cam? And, what's happening with rents? Because I'm looking at some of my properties and, you can't get yourself a rental property.
Yeah, you're exactly right. The rent's definitely going up in leaps and bounds. While I really hate to do short-term predictions, and I've always steered clear to doing short-term price predictions, I've never been more bullish about Brisbane at any point in time over the last 7 or 8 years. You're right, after the last growth cycle, which prices doubled. What year was that, Louis? Do you remember? It's 2004?
4 to 08, just before the GFC hit.
Yeah, 4 to 08, prices doubled in Brisbane, and they've sat pretty stagnant thereabouts. So they're well and truly due for an increase. And they were previous to that. They started to move pre-APRA 2015-ish and leading up to 2017. And then APRA put the clamps on the lending regulations, and they sat there through the midst of COVID last year, 2020. Brisbane defied gravity and started pushing up about July. Really, so we saw huge increases in sales volume through Brisbane, and prices on each land estate that were getting released going up $20,000, $30,000, $40,000 in the next stage. So even prior to this, but yeah, for the next couple of years, mate, Louis, do you want to hang your hat on any sort of, you've got the acquisitions team under your direct report. What are they saying at this point in time?
So, I think there's a couple of interesting things that you've kind of touched on there, Cam, because I think what we did see last year was off the back of home builder, obviously the land market really took off because there was huge extra demand going in because people get obviously government rebates whenever the government offers anything. Everyone's the line at the door just goes around the corner. So that had an impact on the land market, but it didn't immediately kick into the housing market. Now, what we're starting to see now is the vacancy rate in Brisbane, which was at touch over 4% in 2017. At the start of 2017, it was 2.8% around April last year. It's down at 1.3% today. So as you said, Phil, it's very, very difficult to get a rental property right now around Brisbane. So rents are going up. In fact, they're up a touch over 10% in the last 12 months, but importantly, 6% in the last quarter. So imagine that for a year, if you could pull that rate out and your rents go up by 24% in the space of 1 year, would be amazing. I wouldn't expect that that's going to be the case, but I certainly expect that we're going to see consistent rental growth for the next sort of 6 to 12 months. And we're now starting to see, obviously, house prices starting to escalate as well off the back of, obviously, that really scarce or tight rental market forcing first home buyers out, making it a lot more attractive to be buying even established houses over buying land and building and having to wait until you could move into a house. So there's just a lot of extra demand going into that housing market right now, as well as the Sydney-siders, and probably less so right now than there was a year ago, but the Melbourneites all moving up as well. So, yeah, there's a bit of a hotbed, and I think probably it's harder to put your finger on it because it's not statistical, but the Brisbane local government, which is the largest LGA in Australia by population, so they control obviously the millions of people's households and the planning in those suburbs around Brisbane. And a couple of years ago, they made a decision to stop permitting townhouse development in infill areas unless it was medium to high density. So that they used to have what was called low to medium density, and now they're really trying to eliminate townhouse development because obviously voters or ratepayers don't like when there's a new development goes up next door. So we're starting to see the impacts of that right now. Townhouse market is going through the roof just because there's such scarce supply, and obviously that was something that did bring affordable stock to the market. And so there's less and less of that now to help kind of keep prices. And let's call it a pressure release valve. When there is a lot of pent-up demand, if you can't bring in that affordable stock to kind of keep prices down a little bit, it just starts to escalate exponentially. But comparing a 4-bedroom townhouse 12 k's from the city in Brisbane at about $700,000 to a 2-bedroom townhouse 40 k's from Melbourne that costs about the same, there's still really good value in Brisbane than there is, I guess, in the larger capital cities at the moment.
Yeah, and what you're sort of chatting about there is the interpretation or the application of a lot of the macroeconomic stuff that's happening right now and how it plays out into a property market, that being Brisbane. And I want to chat about the other capital cities as well, as in helping investors build out the backbone of a very strong investment property and why they should be considering capital city markets. But I want to just drill down into some of the wider factors which are shaping property market in Australia. We'll go to a break beforehand. When we come back, we'll get into it back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family or giving back to his community. or just more time to go surfing? Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back, everyone. It's Phil Tarrant. I'm host of the Smart Property Investment Show with Cam McClellan and Matthew Lewis and the guys from OpenCorp and our regular podcast. Now, a lot of data coming out lately of recent, and we've spoken about it before when we've got together, gents, about this sort of disconnect between the data that's coming out now and the actual real world environment of property. Sometimes there's a bit of a lag there, but consumer confidence, Cam, irrespective of the COVID-19 pandemic and some of the challenges and uncertainty of Australia, things are still kicking along pretty well.
Yeah, if we think of consumer confidence, and Matt and I often talk about consumer confidence in the sense of sometimes auction clearance rates give an indication of consumer confidence, but it doesn't really. Auction clearance rates in some capital cities like Brisbane, they're not as rife as they are in Sydney and Melbourne. Consumer confidence and auction clearance rates, they're probably not an indication of supply and demand, because really they happen in those inner city to middle ring suburbs. So it's really people just swapping houses faster. But if you look at a clear indication, there's obviously, July, the Sydney house prices went up 2.2% right in the midst of you guys being fully locked down. So there's still that consumer confidence there. And we saw that through Victoria, through Melbourne, through last 2020 when we spent 5.5 months in lockdown. And prices kept defying gravity. So there's still that confidence there. People still have that underlying faith in property as the pricing and prices going up based on the fact that supply is just not meeting the demand around Australia in the four major capital cities anyway.
Another one that I really like, which it's not so much consumer confidence, it's seller confidence. And I think this is a really important one as well that often gets overlooked. People like looking at the median house price, which is really backwards looking. But the asking price is a really good indicator of, I guess, how bullish the sellers are, because if sellers are bullish and they think prices are going to go up, then they're less likely to take an offer that's below their asking price. So pretty much across the capital cities in the last quarter, from Brisbane, the asking price has gone up over 5% in the last quarter. Sydney, similar. Melbourne, similar. Perth, similar. And Perth was probably a little bit flat for a while, as has Melbourne been, but the sellers' expectations are going up because there's not a lot of supply. The amount of stock on the market's been diminishing. And I think when there's not a lot of stock and sellers are bullish, then buyers end up having to pay more as a result. So I think, it's definitely an indicator that probably over the next 3 to 6 months, we're going to see continued, strong price growth across most of those markets. And the lockdowns, as much as they do bite into people's, certainly going back to last March and April, people were really spooked, concerned they won't get another job. I think today everyone's comfortable. We're going to get through it. Everyone will keep working. There'll be a job out the other side of it. And so the big impact is that it creates even more pent-up demand in labour markets, or for labour markets, because there's a backlog of construction that needs to happen, delays supply getting to the market, which obviously increases that pent-up demand for housing stock as well. So, I think a lot of people perhaps saw it as something that was going to really threaten the housing market, when it actually underpins the housing market at times when there's these lockdowns, provided everyone's confident they're going to have a job out the other side of these lockdowns. And we've seen enough of them now to know, yes, it's not great. We've got a few months of living through a pretty painful existence for some people, but out the other side, life will return to normal and there'll be hits of demand for their services.
Matt actually came up, this is probably a good decade ago, the concept of the developer's activity chain, which is, if you think of a standard cycle, Phil, there's a point in any market where supply and demand sort of meet that equilibrium point, where you've gone from a oversupply market to demand sort of meeting that supply line. And at that point, developers generally will go and start buying land estates or start doing development, buying apartment complexes. Now, land estate takes a couple of years to bring to market by the time you go through planning and deliver first stages. Apartments take probably another year on top of that, about 3 years. But what happens if we're leading back to your question about consumer confidence? About a year after that equilibrium point, the supply starts to shrink off a bit and property prices start to move. And that's when investors get involved, or educated investors. About a year after that, the newspapers start reporting good news articles. They flip from being, doom and gloom to property boom. And you get about 12 months of that, and the mum and dad or rookie investors decide they're going to get into the market. The issue with that is that's probably about 3 years through that growth period when the majority of investors start to get excited about the property market. And the sad thing is, for the majority of those investors, right at the peak of the market is when the developers who purchased 2 or 3 years ago are going to start delivering their stock to market, which is hence why you see a correction. So right in the midst of a boom, people start buying property, and then you see that slight dip. It's a little bit different at the moment. We're right at that point. People have seen a couple of years of, or at least 18 months worth of good news stories. Sorry, probably 12 months, Phil, of good news stories about property prices and seen them cranking. So consumer confidence is there regardless of the pandemic. What's not equating is that builders are really struggling to deliver stock to the market. So you're going to have a longer tail on this growth than we would generally, and you won't see that correction as fast in some of the capital cities. So hopefully that explains how the consumer confidence comes out of it.
Yeah, it's and consumer confidence can be quite fleeting. You saw when COVID first hit, doom and gloom, and you see it coming from the major institutions. There was, some banks predicting a 35% drop in property prices, which scared the bejesus out of Australia and Australian investors and all Australians because we have so much wealth tied up in our property. But, the government's pretty much let property run as an engine for fueling better outcomes in terms of consumer confidence and the wealth effect around that. And the sort of question for you, Matt, there's a whole bunch of moving parts at the moment. We've got this sort of COVID uncertainty, but COVID uncertainty has given people a lot of COVID clarity. They've now worked out what's important to them in life, and they're making changes, moving up to Brisbane, for example. We know there's going to be an election just around the corner. We know that the regulators, APRA, for example, can get involved and start pulling some levers to slow down property markets. So where's all this going to go? Is it going to be like a golden run of property for the next couple of years with the government sort of letting the handbrake off? And I sort of put in the context also, if there were to be a change in government, the opposition has come out only the last couple of weeks and pretty much gone, they're not going to tinker with negative gearing. So that's not a bad thing for property investors. What's your conclusion on all of this, Matthew, in terms of confidence to go out there and create wealth through property?
Yeah, I think about what's on people's minds right now, as in the voters, because this is, I guess, I'm not a politician, but I would imagine the politicians are kind of workshopping what's most important for our voter base right now. And I imagine for a lot of them, it's job security and being able to regrow some of the wealth that they might have lost a year ago, or they might have chewed up some of their savings. So they're going to need to play to that. So nobody's going to be rocking the boat from a political perspective. They want the market to be strong. They want to see Australians' wealth growing, and they want everyone in jobs. In fact, they're all working to try and shrink that unemployment rate and see wage growth. So they're all obviously big ticks from a political perspective. So I don't think there's a lot of uncertainty around what the two major parties are going to do from a political perspective. They're just going to try and sell their message slightly different. I think the regulators are probably a different kettle of fish because they're not driven by voter, I guess, perceptions. It's supposed to be around stability of the financial market. That's obviously APRA. So with that, obviously when the housing market starts to boom, their concern is that there might be a bit of a run on prices that could destabilise the financial market. So there was definitely talk around APRA perhaps stepping in later this year. I think the latest lockdown in Sydney, or the extended lockdown in Sydney, certainly put that on hold for a while. Does that mean it's on hold indefinitely? I don't think so. I think they're going to be revisiting and kind of looking at that constantly, but they're going to be waiting mostly for the vaccination rate to be up now. And I think to have confidence that we're not going to be plunged back into a lockdown, because if we did get plunged into a lockdown and APRA started to try and influence buyer behaviour through perhaps tighter lending controls, it could really backfire. So they have to be so cautious about that now. And I suspect when it does come in, it's not going to be a big change. It's going to be incremental, similar to how they used to play with interest rates, where they might just put 0.25% on. I don't think they'll play with interest rates right now. They're going to try and do other controls to try and just balance out the market a bit.
It's a tough one, and at a sort of sovereign level, our ability as a nation to borrow money is pretty important. And the rating agencies are sort of giving a thumbs up to Australia and how we've gone about doing it, which is inherent to how successful and stable our major banks are. And obviously that underpins the Australian property market. So the environment is good. However, there's still a bit of a grey zone around it. And considering all this sort of stuff, elections, APRA, you can get absorbed with all the reasons why you shouldn't invest in property. But Cam, what would you say to property investors right now? What is the most effective way to invest in this sort of COVID impacted market when there is opportunities for smart operators?
Yeah, I think Matt and I were very clear the best part of 15 to 20 years ago when we came up with our set strategy, which was basically derived from Matt's old man and us having lots of lunches with lots of grey-haired investors, and then documenting the process of purchasing across the main 4 capital cities. And you go back to your original statement when you opened, Phil, about the capital cities doing well as opposed to tree change areas and those sort of things. Due to a number of things changing through our capital cities, Matt and I have expanded the criteria we use. So going back, how do you buy a property through these areas? You fall back to the fundamentals of every decision you make when it comes to investing, because what made sense 5 years ago will make sense in 5 years' time. We're just riding through some anomalies at this point in time. The expansion of our criteria, which I outlined in my 4-year-old, The Property Investor, the investment book, which has a new edition of that coming out within 2 months. It's at the typesetters at the moment. So we're at the back end of another painful rewrite of the book. But this is probably the biggest change to this book. So Matt and I have expanded it to cities with a population growth above 200,000 people, but we've got a lot more stringent, because some of the major capital cities obviously meet that. But a lot of the things we put in place are 1 hour commute to over 500,000 jobs, has to have an urban growth boundary. The work options need different sectors need to have no more than a specific percentage of jobs coming from a specific sector. But one thing we've also looked at is the participation rate, because there's a lot of, say, regional cities which might meet the population criteria there, but the participation rate, there's a lot of old people, so they're not actually contributing to the economy in those areas. So to answer your question, it really comes back to going back to having a strategy in place to invest in property and having a criteria that your property selection must meet, and just following that, because you're going to be right coming out the back end of it. So some of the major capital cities don't meet that criteria, but some of the smaller cities do meet that criteria. So we've got a lot more stringent in what we'll invest in and what we'll allow our clients to invest in.
Okay, that makes a lot of sense. And you know what? Property shouldn't be hard, right?
That's right.
Find a strategy, adapt a strategy, and execute it flawlessly. Yeah. But that's where most people get it wrong. I want to get into some of the actual capital cities. Let's go to another break. Stay with us. Back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back, everyone. Phil Tarrant from Smart Property Investment, and with Cam McClellan and Matthew Lewison from OpenCorp. Now, Matt, let's get into, we've spoken at length at Brizzy within the context of the Catalyst winning the Olympic Games, so we don't need to revisit there. And the question is, I guess that would probably be one of the locations per your book, Cam, where you're probably giving a thumbs up to investing in Brizzy, yes or no?
Brizzy gets the tick. There's a couple of corridors in Brizzy I don't like, but Brizzy as a major, yep, that gets the tick.
Where don't you like?
Out in the east, probably further out in the east, there's a couple of corridors through there that have probably still got a little bit of potential oversupply, or there's enough vacant land that can be brought to market, which may dampen growth. I mean, there's an old saying, which Steve, my mentor, taught me, all boats float in a rising tide, but some just float better, and some can sit back a little bit if there's a lot of supply that can come onto the market in the next 5 to 10 years, which there still is a couple of corridors through Brizzy that have that.
And by east, I think that Cam means west.
Yes, sorry, mate. East, yeah, there's sort of an ocean east, isn't there?
Yeah. I was trying to think, is that like, along the coast there, there's some pretty grubby beaches.
Morton Island, yeah.
Yeah, that's right. My moral compass is off, mate.
But that's I guess what Cam is chatting about there is a really simple base philosophy for effective property investors. It's about, yes, you can put your money in a market and it will go up because the whole market's going up, but where should you be deploying your money to make sure you're getting the best bang for your buck around it? So just because it's rising, there's probably other areas that are rising more effectively. Now, Matt, let's have a chat about Canberra. Does this sort of fall inside your doctrine for investing in this current market?
So unfortunately, Canberra doesn't actually fit into our criteria still. And perhaps just a little bit more context for how we've looked at over the last 10 years, kind of where we eventually landed on and why we changed the criteria. If you look at cities around some of the older countries around the world, it's one of the great things about being a fairly, I guess, young civilization in terms of like modern Australia. The way our cities evolved followed a pattern that other cities have evolved through over hundreds and hundreds of years before us. But if you look, for instance, in the US, they've got only 2 cities that are bigger than Sydney and Melbourne, but they've got about 100 cities that are over 500,000 people. And if you look at the pattern of these cities, often there's about an hour to an hour and a half drive between the smaller cities and the larger cities. So when you follow that and you look at same in Europe and Asia, there's this connection between cities. So some cities might sit down on their own, in which case they need to be fairly big to survive. So we really looked at not just the major or the capital city, but what are the other minor cities that kind of are around those that share the same jobs market, that have really good handy commutes between, have reasons for existing as well. A city for the sake of having a city somewhere often means that if an industry leaves, and let's look at Detroit in America, I mean, their motor industry left and the whole city became a ghost town. There's been documentaries about that city and how kind of society devolved over the course of a few years. So we've kind of gone right into that to understand the structure of cities and how they evolve, to then look at what Australian cities are doing, what's likely to lead to better growth in the future. And we know that Australia's cities are going to continue growing for quite a while. And if you look at our population projections, and obviously pre-COVID, there was obviously a forecast of getting to 45 to 50 million by 2060. Yeah. So if we're going to grow by 20 million people, does that mean we can dump 20 million into Sydney, Melbourne, Brisbane and Perth? Absolutely not, because they would be tripling in size and still there'd be leftovers. So the majority of that population, yes, there's going to be, those cities will grow, but other cities around them are going to grow too. So it's the likes of the Gold Coast, the Sunshine Coast. If you go down to Victoria, Geelong, obviously is another one of those cities. There's a great lifestyle and there's a lot of different employment opportunities. It's an hour's commute to Melbourne itself. So we've really gone right through like that. Unfortunately, with Canberra, the criteria that we really looked at, which is the population growth over the last 10 years and the forecast into the future, as well as jobs growth, the variety of jobs within a market. So we don't want to have too much concentration in one or two industries, because as we see with Detroit, you pull one of those industries out, it can have a huge impact on that market. So Canberra didn't quite fit into that criteria. Now, that said, some of the fundamentals of Canberra have been really strong for a while, and it's certainly got a low vacancy rate, it's got increasing rents, got price growth. They're obviously going through a transition with the way that their stamp duty applies as well, which kind of seems to have had a positive short-term effect on that market as well. We're not sure. I mean, it's a bit of a test case, isn't it, for stamp duties around Australia? We're not sure how that's going to evolve in the years to come. And we tend to be more cautious than bullish about markets. So we, I guess, like to sit back, and if we're uncertain, we like to sit out and monitor to see how things go. Because I guess I'd rather miss an opportunity by investing somewhere else and maybe miss a tiny amount of growth, but be a lot more certain about the outcome. So that's kind of our position on Canberra.
Okay, so Canberra's out, Brisbane's in. So what else is in?
So Sunshine Coast, Gold Coast, particularly certain spots within those. So we like to be, for instance, on those larger satellite cities in an area that's still got a good commute distance to Brisbane. So if I look at the Sunshine Coast, then you've got a fairly long stretch of coastline, and it can be about a 45 minutes drive from the southern end of the Sunshine Coast to the northern end. The northern end is real holiday territory up in Noosa. The southern end, close to Maroochydore, where there's a new huge city, I guess, being built there. And it's about an hour 20 drive down to Brisbane, and there's train access from that. So that southern end of the Sunshine Coast ticks the boxes, whereas the northern end, very high prices will leave to the holiday makers and obviously the people who've got the holiday homes that want to move up from Brisbane. But certainly the southern end we like and ticks the boxes for us. Similar with the Gold Coast at the northern end of the Gold Coast, where you're going to have that same, I guess, transport opportunity up to Brisbane, albeit that there's a bit of scarcity of land in that market at the moment as well.
So these are potentially commuter belts, right, into Brizzy. So you could probably have a hybrid life.
Yeah. Oh, and if you think about population growth, people moving from Sydney, Melbourne, understandably, it's going to have a bit of a draw card, particularly if they haven't spent a lot of time around Brisbane or have family and friends in Brisbane, but you kind of want the best of both worlds. That can really play into it as well, like understanding that lifestyle element. And certainly we did observe through 2017 to kind of 2020 that they were picking up a greater percentage of, I guess, the new interstate arrivals than they had of previously. And I think that's probably just a recognition to the fact that they do have a good commute now through infrastructure, but also that there's broader economies in those areas themselves. They're not just holiday destinations anymore.
Okay. Sydney.
Yeah. So Sydney we've talked about before. And again, I guess one of our approaches with Sydney, we know that it's a bit of it leads the pack in terms of price. And if we think about the Olympics, I don't know if you guys watched the semi-final of the 800 metres that Peter Bol ended up winning. There was a guy leading the pack for most of the race, and Peter Bol kind of sat on his shoulder and ran past him. The guy who was leading for 750 metres ended up finishing seventh. I'm not suggesting that Sydney will end up finishing seventh, but certainly Sydney leading the pack tells us a lot about the rest of Australia. It tells us what Melbourne residents should be able to afford in terms of house prices. The median wage is actually not dissimilar between Sydney and Melbourne and Brisbane. So Sydney's obviously got a lot of embedded wealth in the city. That helps to sustain higher prices, but it also helps to set the benchmark for other cities. So that's one of the things. Probably also we've been, I guess, mindful that Sydney's had a higher vacancy rate than most of the other capital cities for a fair while now. Even pre-COVID, it was sitting around that 3%. It's actually starting to trend down now. And I'd say that Sydney has, in some measures, slightly better fundamentals than in Melbourne, for instance, or parts of Melbourne. Sydney's got really scarce land supply, albeit that the market seems to be obviously it's inflated and the yields are quite low. So that's obviously a big impact for us as well as investors. We want to be able to hold as much property as we can. And the income you get from the property relative to what you pay for them is really important for your borrowing capacity. So you pay more to get into Sydney, but you get less rent than you do, particularly in some parts of the market, than in other cities. Now, if I flick down to Melbourne, the eastern suburbs, southeastern suburbs, tight, low vacancy rates, and very, very, I guess, strong market still, even through, I guess, what we've been through over the last year. The western suburbs, on the other hand, there's still an absolute ton of land coming through and still queues of people lining up to buy more land. So that's a bit of a concern to us in the western suburbs of Melbourne, that there already appears to be an oversupply that's got the highest vacancy rate in the market now. Even the CBD's been trending down really strongly in Melbourne. The western suburbs is high. And with all those land sales, it's just going to mean more production of houses, which will just be dumping more supply in that market. So Melbourne, we still like, but we'd be probably weighting towards the eastern and southeastern suburbs there.
And that goes back to where you deploy your money most effectively. But I imagine a lot of property investors just listen to that going, like, where do I start now? How do I get going? And the question to you, Cam, well, what's the best way? Like, you've got this information and we're very fortunate now that information in property investment is largely democratized. And I like to think the Smart Property Investment Show helps with that. It means, it's not a secret now. It's, it's out there, but it's how you choose to act on that information. Sort of what would be your one or two key approaches, mate, to move into investing effectively now in this market if you've got cash on hand and you're finance ready?
Yeah, I'd be doing a couple of things. I think one point Matt made there is really important for investors to take into consideration. Each investor's own financial situation is very different. So working out your own borrowing capacity, because one point that Matt just made then, hypothetically, if we talked about, let's pretend Sydney gets a higher growth rate than Brisbane for argument's sake. But in Sydney, the rental yield's lower. So you might be able to hold $1 million worth of asset in Sydney versus $1.3 million worth in Brisbane. So holding the most amount of asset with the least amount of your money out of your back pocket is one of the keys to growing your long-term wealth. So it comes down to understanding your own borrowing capacity, what you're able to achieve, and then having a set criteria to check the capital city markets, the areas within those, and then find the optimum size and quality property for an area. So you've got to have a process. There's no use just following the whims of something you heard. And if you don't have that, we've got check sheets at OpenCourt we can provide investors if they want those for free to keep them safe. If they don't have the time or the motivation, well, we can do it for them. But the main thing is to have a process that gives you the right outcome.
Yeah, and it's one of those things, process and routine will set you free, and very much, property investment isn't that sexy. It's numbers and as I said, flawless execution, and that's what the best property investors do. Gents, that was super informative. Thanks for your time today. And, every time I do chat with you, it sort of just helps me realign myself with my portfolio and investing. So I might go and do some property stuff at the moment. I've been spending a lot of time lately just trying to call up all the banks, and no one can see me right now. I'm wiping my eyes because it's such a soul destroying job. Sort of 5 or 6 different banks calling them up saying, give me a cheaper interest rate. It's an absolute nightmare. But you know what? It's what makes your portfolio more effective. So if you haven't done that recently, I highly recommend go and do it, because some pretty sharp rates around at the moment. Cam, I'll leave it to you conclude, mate. What's sort of got to be your guiding light for the next sort of couple of months in terms of making more informed investment decisions? Just getting the basics right, no doubt.
Yeah, no, it's definitely getting the basics right. Steer clear of mainstream media or social media. The social media is probably one of the most, I suppose, uninformative areas of information, just because there's small opinion pieces. Everyone's got an opinion. A lot of it doesn't have foundation. So, yeah, if you're making a smart decision, get your borrowing capacity worked out, follow a process, and invest for the long term, Phil, as you know.
I completely echo your social media stuff, and I'm sort of quite conscious, a bit of a privilege that just how well sort of connected I am with Property in Australia. I can pick up the phone and talk to anyone or anyone who's good. I'll preface that, and I sometimes flick through Instagram or something while there's something crap on TV that someone else is watching, and the mind boggles the type of information that people are peddling on platforms like that. Ill-informed investment advice, ill-informed property investment advice. Just be really, really careful out there.
Yeah, I think it's a ripping point you made. We've been around for nearly 20 years and our board members have been investing for 50 years. I see a lot of companies pop up every growth cycle. There's a couple around at the moment doing huge volume, but investing should be the long term. So if you're going to invest with a company, invest with a company that's been around for a long period of time, because that means they're going to be around for a long period of time. So I think Matt and I worked out there's probably only 4 investment advisory companies that have been around since we started. Now, I know there's dozens and dozens of out there at the moment, and you see them come and go. So if you're going to do it yourself, follow a process. If you're going to choose a partner, choose one that's been around for a while.
That's good counsel. And, I've seen a lot of companies come and go. And when they go, they go out with a bang.
Yeah, the worst one I think was old Henry Kay. I think around 3,500 Australians lost collectively around 60 million through that. Yeah. And there's worse going on in the market at the moment, believe me.
Yeah, and this goes back to the point, back when he was around, the only way to get property investment information was go to a seminar. But now now the good operators, and I definitely include you guys within that, are more than happy to share your knowledge openly like this. So there's some merit in that. Gents, thanks for your time today. Really enjoyed it.
Thanks, Bill.
That's
Cheers,
cool.
Bill.
Nice one. That's Cam McClellan and Matthew Lewison from OpenCourt. Go and check these guys out. Hope you enjoyed that. Everyone, remember, you can follow us on Smart Property HQ. That's where you like to get information. It's social media, but it's the good social media.
That's right.
I'll just preface that. But quick favor for me, guys, if you do enjoy these podcasts, I get to do the good bit of this job. I get to talk on the microphone, but there's a big team here who make all the magic happen. They get a real kick out of those reviews if you can keep them coming, whichever podcast player you're tuning into this on. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
In the property investment industry, there's countless stories of the one that got away. And it's always the same reason. To pay the deposit, they needed the settlement from another property to come through, and they waited. Realty Assist Australia knows that when you find the one, waiting isn't an option. That's why they have a same-day settlement fund advance service. There's no credit check, no application fees, just a single one-off fee to advance your equity. Visit realtyassist.com.au/settlements now.